Hello, we are here for another Coffee with the Collective. For those of you who don't know me, I'm Kelly Parker. We've got Mallory, who is a wonderful CHC team member with us. We've got Peter Alving, who is our lender extraordinaire, who we have been working with, me personally, have been now working with for 12 years, I think. So he is truly our go-to. It's who we've been using for all of our clients and ourselves included. And we really wanted to bring this topic forward because we're having so much of this happen with our clients right now, which is lots of conversations around how much to put down. You know, there's a real myth out there that you need to have 20% to buy a home or buy a condo. And the truth is, I bought my first home definitely not with 20%, more like 3%. Mallory is doing her purchase right now also with 5%, and Peter has been the lender for both of us, actually. So we wanted to invite him on today to share, more of the specifics around if you're someone who doesn't have 20%, or even you have 20% and you don't want to use it all for your down payment. That's completely possible. And the truth is, some of the recent statistics that have come out are showing that only 44% of people, or not only, but 44% of people over the age of 30 are putting less than 20% down. And actually 8 out of 10 buyers under the age of 30 are putting less than 20% down. So I know I fell into that category. I bought my first home at 28 years old. Peter was my lender at the time. I bought that home. We were just recapping, actually. We're reminiscing on the good old days that I put 3% down on a $220,000 townhome that I bought back in 2012 now. And I was 28 years old. It was literally the savings that I had to my name, but I really prioritized homeownership and I wanted to get my foot in the door and I didn't want to wait until I had 20% down. So I know that there's a lot of myths around that and we want to kind of help create some clarity for all of you. But Mallory, will you please share your story a little bit with your purchase going on right now with Peter?
We're so excited. And Peter, I can't thank you enough for just all the education and the availability. I know that we've even been texting and it's just been awesome, even just to get updates on the market throughout. But for us, we ended up doing 5% down. We're big savers and we don't like spending. And when you're buying a home and putting down 20% or a large amount down, for us, it just didn't align as well as hanging on to our cash. We wanted to be able to be prepared. We're going to be expecting our first baby and getting our first home together. We got married last year. And so we're just trying to hang on to as much cash as we can and be strategic. And if we have the opportunity to still have our monthly payment be in a comfortable spot. And I know we're going to probably mention some PMI, but for us, the private mortgage insurance that comes with putting less than 20% down was so small, it wasn't even worth mentioning really, because it didn't make a difference in the grand scheme of things. For us, it made more sense to do that less down.
But yeah, we'll dive into PMI, Peter, because I know that's a big thing that people want to talk about. But first, I would love to hear, why you see people putting less than 20% down. I know for me, that was all that I had saved and I wanted to get my foot in the door. And for Mallory, they wanted cash on hand because their family's growing and they just feel more comfortable holding it. But what are other reasons you see people doing it?
Yeah, that's definitely, both of you guys are we're similar position, first-time home buyer, and every person's different. Let's kind of preface that. And everyone kind of makes a different decision as far as what they want to do with their money, especially when you are, buying a home for the first time. There's decisions you have to make as far as what you can afford monthly. And also what you have to actually put towards the down payment in liquid funds, stocks, bonds, mutual funds, checking, savings, and then how that kind of translates to you financially, intelligently. So when you're pre-approved for a mortgage, that's kind of the first question that we ask is what can you afford in your life? What do you feel most comfortable paying monthly. And then also the question is, what do you actually have, and how comfortable are you using those funds? So there's some people out there that have lots of money, but can only afford a certain down payment. There's conversely people that can afford a huge down payment, or don't have a lot of money, but can afford a huge monthly payment. So those type of people, we try to kind of run their numbers specifically, come up with a game plan, and the people that decide to put down less than 20% have a few really good options for that. Putting down less than 20% also allows you flexibility in increasing the equity in the home. So one thing that people, when you're first buying a home and you don't know really anything about the mortgage process, you hear something like you said, mortgage insurance. So one thing is, if you put more than 20% down, you do not pay mortgage insurance, okay? What that means is, on a conventional loan, so a Fannie Freddie loan, so the two government institutions that buy and sell or control the insuring of loans on the open market, allow you to not pay mortgage insurance to insure them, the lender, against your default. So if you foreclose on your home and you had put down more than 20%, then the lender is not insured against your default. If you put down less than 20%, those lenders will require you to have mortgage insurance. And if you do default, they will be paid by those mortgage insurance companies a certain payout, just like any other insurance premium. So they're protected because you put less skin in the game.
Okay, so to recap, because you, in true Peter fashion, you just told us so much valuable information. So I want to dissect it a little bit. So first, we're going to go back to PMI, but prior to that, you had made a really good point, which is that some people will choose to put less than 20% down because they want the cash to do updates to a property to improve the equity, or even their own, desires, right? So you could choose to put less than 20% down because you want to update the kitchen and you want to save 15 grand of your cash available to do updates. And I think that's such a wonderful thing to think about, because a lot of times people think, oh, I just can't afford to put more down. And it's actually used as a strategy quite often.
Exactly. So that's the thing. When we're coming up with your strategy, one of the disadvantages to putting down less than 20% is that mortgage insurance. But one of the big advantages of putting down less than 20% is having that money in your pocket. So if you do not put down 20%, let's say you put 5% down, 10% down, you will pay mortgage insurance for that loan. And you either have the option of paying that monthly, or you have the option of paying that in bulk at closing. So you actually technically can pay the entire premium at closing, and not pay that monthly. So
I paid mine monthly. To be honest, the value of me getting in the door was worth the extra. I will never forget $143 a month in PMI. Yep. That eventually fell off, and we were just reflecting on this. It's because of the type of program that I use, which we want to definitely talk about. But my PMI, I still own that property. So I bought it back in 2012 at the low point of the real estate market for $220,000. I lived in it for 4 years. I've then since been renting it out. I cash positive by a lot every month, and that property is now worth $550,000. And the trade-off to me getting my foot in the door was paying $143 a month in this is insurance payment that you're mentioning.
Exactly.
So and I know same thing for you, Mallory. There was advantages.
We plan to hold on to it for a long time. There's no rental restrictions. Putting and dumping a bunch of cash into it for a down payment just didn't make sense. Like Peter said, whether we want to redo the kitchen, it is a little bit of an older kitchen, although it's functional, or like Kelly saying, to kind of hold on to that cash, whether you have it or not, to be able to rent it out and kind of leverage the property and your financing in other ways than just a down payment.
Well, the people that put down 20%, let's just kind of look at it that way. So the ones that do decide to would be, let's say, the perfect situation. Let's say this is their forever home. We say they're going to be, leaving the home in a pine box. Let's say that the market was the absolute lowest ever. Let's say that it was, a year and a half, 2 years ago, that we're talking 3% interest rates. So, they're getting in at a payment that is comfortable for them for a while with no mortgage insurance at the lowest interest rate possible. Then that mortgage, they're going to have that possibly for 30 years. Who knows? I mean, the percentage of people that have it for 30 years. Anyone else, let's say, especially in the city of Chicago, like you guys, we have condos here that need a lot of work. So, or single family homes that need a lot of work. So when you buy a house like that, we can kind of look at these initial loans that you're buying the home with as bridges to get into that house. And it's a mortgage that you're not going to have for very long. It's a temporary mortgage to some extent because you're going to be using the money that you would have put in that down payment to put into the home on the back end. So let's say that you'll improve the kitchen, you'll improve put new floors in, put a new bathroom in. So you had 20% technically, you only put 5% down, you improved the house on the back end, you bought the worst house on the best block, you have amazing comparables, you can refinance eventually in, let's say, a year, 2 years after you've done the work. You may then eventually have 20% equity, 80% equity in the home.
Yeah.
20% equity in the home by then. You can refinance and then get rid of the mortgage.
The PMI.
Exactly. I love that.
Possibly by then have lower interest rates too, and lower your interest rate and have a perfect refinance experience. Who knows?
And what I love that you're showing is this is why having conversations, whether it's with an agent or a lender, well before you even want to buy, you're just considering it, it's something you desire to do in your life, is so beneficial because we can help craft that strategy together, and we do this a lot with our clients. They start by talking to us, we send them to you, you look at their numbers, we all kind of come together, and there's a whole bunch of nuances, right? Sometimes both partners are on a loan. Sometimes we only do one. There's a real thoughtful strategy that we can put behind it, but giving yourself some runway to really understand what your options are, it just helps, I think, create so much clarity.
Yeah, it's a tool. And the goal isn't to put as much money it is into your debt. The goal is to put as much money as you can into the asset, the actual equity that you have in your home. So eventually,
it's a good differentiator.
Loan, just like you have, either you're going to refinance into that final loan, or you could have just one loan for a long time that you had mortgage insurance on that eventually fell off, which is, that's the dream to some extent, especially if you had a low interest rate for that period as well.
So let's talk a little bit, now that we've kind of covered why people would do it and the different strategies, will you share a little bit with us about the difference between FHA and conventional? Because there's a lot of misconception. People think when they hear the word conventional loan, it means you're putting 20% or more down. And then FHA is anything under 20%. And I know and again, I'll say there's a lot of nuances to this. And so we try to not open every can of worms, else we'll be here all day. And this is why Peter's a great resource to go talk to outside of this call. But can you give us surface level the difference between what is conventional and then where does FHA kick in? And I know there's government backed and all these things.
Sure. Yeah. And that's the thing. I have a lot of people that come to me that, the only option in their mind from what they've heard is 20% down. And anything less than that is bad for some reason. I get that a lot. It's just kind of for some reason it's bad, but it's actually, there's lots of tools out there that the government has allowed home buyers to pursue, and also the banks to some extent. So the government is involved in two different ways. Number one, the one of the main programs out there that allows less than 20% down is an FHA loan. So that's a federal loan that is that allows 3.5% minimum down. And one big aspect of an FHA loan is you're required to pay a percentage of the loan amount upfront at closing, which is not necessarily the most favorable thing. It's more money out of pocket. You also have mortgage insurance that tends to be on a higher end than the conventional loan, which I'll get to. And you also pay that mortgage insurance for the entire lifetime of the loan. So
what would be the benefit of someone doing of FHA? And FHA stands, because I want to make sure, I'm sure Federal Housing Administration, right?
Correct.
What's the benefit of someone doing an FHA versus just another type of loan that's 3 or whatever percent down?
Sure. Well, one of the main reasons would be if you can't do, you're not a first-time home buyer. So that would be one of the reasons why you couldn't do the Fannie or Freddie first-time home buyer programs, which also allow low down payment. So Fannie, Freddie,
that's what both Mallory and I did. Which is
the conventional.
The Fannie Freddie loan. So Fannie
first-time home buyer, got it.
First-time home buyer, they're called Freddie's is called Home Possible, and Fannie's is called Home Ready. And so, as opposed to the federally insured loans, where the government insures your loan against the default that we were talking about. So, if you're foreclosed, the government is going to insure the lender against that default. Okay. So on a Fannie Freddie loan, which is a non-government loan, it's a private lender loan, is insured by a private mortgage insurance company instead of the government. So those loans that are insured by the private mortgage insurance companies actually allow lower down payment of only 3% down. There is no upfront mortgage insurance. And the monthly mortgage insurance, depending on the private mortgage insurance company that is insuring the loan, so MGIC, Radian, those are the big companies out there that are the private companies that insure it. So you guys had private mortgage insurance. So you guys had a private company that was insuring that loan that was separate, as opposed to an FHA loan that you're actually paying each month, each payment to the government, your mortgage insurance.
Okay.
As opposed to the private ones, you're paying a private company. So that money that you're paying monthly goes into a pool, and if you foreclose, the insurance coming out of that government pool.
Got it. Okay, that is such a great differentiator, because what yours, and I didn't know this until we just started chatting about this. So what you're saying is that 3%, 5%, 10%, whatever, you could do that as one of these first-time home buyer options you just listed, right?
So that only 3% is the exception. Anybody, no matter what, on a primary residence can put at least 5% down. Okay.
So good distinguisher.
It doesn't matter. You don't have to be a first-time home buyer or anything like that.
That's good to know. Okay, wait. So then FHA. So FHA, do you have to be a first-time home buyer, or can you not be a first-time? I think there's a lot of confusion around that. I think people think they have to be a first-time home buyer.
So FHA, you don't have to be a first-time home buyer, but your PMI never falls off, and you can do as low as 3.5%. But the conventional, you can do as low as 3%. And if you're a first-time home buyer, you can do the programs to kind of help out. Otherwise, you can do as low as 5% and still be conventional.
Correct. And the mortgage insurance goes away on the conventional.
That's awesome.
Once you're at 20%, it never goes away on the front.
So that's what happened to me on my townhome after 8 years, when I had paid down a certain amount to meet a 20% equity mark. All of a sudden, just one day, the $143 was gone, which was amazing. And that explains it. But if it was FHA, it would never fall off.
It would never fall off.
And this is like such a good point as to like why we need to talk to Peter and have that runway and kind of get that game plan. Like, what am I saving for? What, like, do I need 10 grand? Do I need 15? Do I already have it? And how am I going to allocate this to make it all make sense?
And same, like, should I be afraid of PMI, or can I factor in that it's going to fall off in a few years? Like, this is all these swirling things that can feel very overwhelming to a buyer, but with the right partners, right? Like, this is very manageable.
Yeah. It also depends on how much you put down. So you could put down 15% and have mortgage insurance. You're going to have a lower mortgage insurance monthly. So you're talking $143. If you have 15% down, that could be $12 a month, $13 a month, depending on your loan amount. And you're a lot closer to that 80%. So you only have 5% more for that mortgage insurance to go away.
Okay, wait. So let's talk about that, because I just saw there was an article yesterday that came out, and correct me if I'm saying this wrong, but did the PMI get reduced? And the PMI, actually, I should say this. PMI is based on your loan, the amount that you're borrowing on your loan, right? It's a percentage of that. Did that percentage get reduced?
So that percentage got reduced for FHA. So FHA has across the board a certain percentage. If you put down less than 10%, you have a certain monthly percentage. If you put down more than 10%, you have a monthly percentage. That's lower. And what they did was they lowered that by, I think, 0.3%. So it lowered 0.3% on that monthly mortgage insurance for FHA. And not lower for the conventional loan on the private. So on the conventional loans, the Fannie Freddie, let's say you have 5% down, I'm doing the same thing. I'm shopping those mortgage insurance companies. You don't even realize it, but so MGIC may have a $50 more higher premium than Radian does, or Radian might have a higher than another one. So we're actually shopping the lower mortgage insurance monthly for you.
Yeah,
as well.
I know, Peter, for mine, my PMI is like really, really low.
Yeah.
Like how low, Mal?
I don't remember exactly what it is because it was but it was like 30 maybe. It was like something ridiculously low.
So when you were saying, because you said the other day, you're like, it's less than a gym membership.
Oh yeah.
Exactly.
And I'm talking like, a Mac Daddy gym membership. It's just above a Planet Fitness.
Yeah. And that's a great way to look at it. And we can think that that's probably going to be temporary for you. And because I'm thinking you're probably going to refinance, you're probably going to do something to the home. And hopefully if rates go down, you're going to either refinance because of that, or you're going to watch, you're a real estate agent, you're going to watch your comparables around you. And let's say in 2 years from now, you see 4 sales that are $60,000 more than what you purchased it for. You're like, hey, if I get this appraised right now, I could possibly get this. Then you could do a refinance, get the new appraised value, then whatever your loan amount is. So whatever your existing loan amount is at that time, if that new appraised value is more than, then that current loan amount is 80% of that new value, then right away we get rid of the mortgage insurance on that end. Now, we'd only do that, obviously, if the rates were lower, or it made sense that that mortgage insurance you're getting rid of would have lowered the payment enough if you got a higher interest rate. But that's what we play with. But
that's awesome.
Like you said, the lower down payments are tools, possibly for every borrower is different, to gain equity in your house. So putting the lease amount down, and even though you had 20% down, put the new kitchen in with that 15% down.
Or go buy another property. Mallory, I think that you and I were the one talking about, like, you guys have a desire to own investment properties. So, like, you are secured your primary residence.
Yeah. So Sean and I did it where it's just under Sean's name now. So for us, being stronger as a couple, being able to have it just in his name, so that when we go to get another property in the near future, we don't even have to take Sean's specs into consideration. It's just mine.
Exactly.
I love this because this is actually a topic for another coffee with the collective about how to be strategic, because we did the same thing. Not both of us. We are not on all all of our property loans. We each
Right.
have our own because of the debt to income. But Peter, this was so wonderful. You're such a well of knowledge. I honestly can nerd out with you on this topic all day long. But not only are you like a well of knowledge, but you take such good care of our clients. It is so heartwarming, truthfully, to know that like when we send people to you, that you take as good of care of them. You're super passionate about not just financing their loan, but making sure that it's the right strategy for their financial situation. So forever grateful for, all that you do for our clients. And anybody who's watching this, even if you don't think you're going to buy in the next year or 2 or 5 years, it never hurts to connect with Peter or us on just, these are my goals and how do I get there? So wonderful. So I appreciate everything you do for us always. And
Pleasure.